Good morning, friends. We are here from Peerless Mutual Fund. We want to share our outlook for 2015 in the fixed income markets. In the fixed income markets, we expect a total of 50 basis point rate cut by the RBI in 2015. The first window is after the budget, and the second window we see is in the last quarter of calendar year 2015. So far, we have had three main salutary effects on interest rates in 2014. We expect this to continue and play out with a lag also in 2015. The first has been the remarkable stability of the INR currency, ably managed by the RBI through build-up of reserves and intervention. This has been in sharp contrast to other emerging market currencies except China, where there is a peg to the US dollar. RBI has alluded to increasing currency reserves in line with if and when the Federal Reserve increases interest rates, which is now expected to be in the June to September quarter of 2015. As has happened in the past, this event is expected to create volatility in CAD currencies or current account deficit currencies like the INR. This stability has also allowed RBI to become dovish on interest rates, despite periodic shock events in the global economy, the latest being Russia. The second has been the compression in the fiscal and the current account deficit. The current account deficit has come down over a clampdown on gold imports and also falling other imports. The change in government at the center in 2014, in May, with a more business-friendly and right-of-center orientation, meant that the ease of doing business in India has greatly increased, and the fiscal deficit has been curtailed by reducing spending. Spending on both plan and non-plan expenditure is being curtailed as the projected revenue buoyancy has not yet materialized. This has reduced the velocity of money in the system, thereby bringing down inflation and interest rates and particularly helping the fall in yields in the bond market. However, in the first quarter of calendar year 2015, this can lead to liquidity tightness unless supplemented by the RBI and a further fall in GDP. The government in its recent economic outlook and the statements by the economic advisor give an inkling to the policies to be pursued by the current government. The thought is to keep the fiscal deficit at current levels and use the extra space available to kickstart public expenditure from the government. This is due to the shortcomings of the public-private partnership in the infrastructure space. The FRBM Act, which was suspended in 2009 and later resurrected, was supposed to have a glide path to 3.6 and 3.3% of GDP in terms of fiscal deficit. This, is now being proposed to be curtailed, and if it happens, is expected to kickstart investment in infrastructure and growth. However, this is also expected to put a floor to falling inflation beyond the seasonal variations. The third salutary effect has been the falling international price of crude in the second half of 2014. OPEC's decision not to cut output in 2014 led to a seminal fall in crude prices from the $90 per barrel to the $60 per barrel mark. However, prices need to stabilize at these levels or lower for at least a couple of years to drive out the excess supply due to shale fracking that are existing and those that have been planned. This is typical behavior of a monopolistic competitor that seeks to drive out new supply. Interestingly, the existence of shale fracking also acts as an upper cap for international crude oil prices, as the supply can be shut down quickly and again started quickly. What matters is how much does a consumer pay for a liter of petrol or diesel in India. In this area, the government has moved swiftly to capture the drop in international crude prices and increase taxes on these products. State governments would tend to move likewise as petroleum products are out of the purview of GST. This would help in plugging the deficit gap due to lower than projected tax revenues. The Indian basket of crude oil has dropped some 12.3% per barrel in November, and yet retail petrol and diesel prices in Delhi have dropped to much lower 1.4% and 1.6% respectively. What this will do is to put a floor on the fall in inflation in India, and hence we do not expect drastic cuts by the RBI in 2015. To sum up, we expect a total of 50 basis point rate cut in calendar year 2015 with bouts of liquidity tightness. In this environment, we recommend that the PLS short term fund be the preferred vehicle for investment for a horizon of 6 months and the PLS flexible income fund for higher investment horizons. Thank you, friends.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.